credit scores or credit ratings, they're used to predict your future behaviour using your past behaviour. Hi everyone, welcome back to my channel. I wanted to do a video today on credit scores and sort of like mortgages. It's just things that I'm learning as I'm trying to go through the process of applying for a mortgage or getting a mortgage, and I just want to obviously share what I've learned so far or things that can impact it. I do have to put a disclaimer in that I'm not a financial advisor, so please do sort of like have a look into these facts yourself as well, and if you need help then actually do go to a proper financial advisor. But these are just things that I've learned so far in to do with credit cards and credit scoring and mortgages. So the first thing to know is, number one, know the difference between a hard credit score and a soft credit score check. So with a hard credit score check, this is something that will actually show on your credit score. So if you apply for a mobile phone contract, if you open up a new bank account, if you take out a loan, if you take out a credit card, things like that, they are all hard credit score checks that happen when you take the product out. So this will show. But with soft credit score checks, this is something that won't actually show to lenders on your credit score, so it won't actually impact it. With hard credit scores, they can bring your credit score down for a little while before it goes back up, but soft credit scores don't actually do this. So with a soft credit score, this is things such as Experian, where you can go and check your credit rating. Not all credit scoring or rating agencies use soft checks, so it's best to check which one they do use. But I know Experian has soft credit ratings, which is something to sort of like know about if you're going to be checking your own credit score. So if I am looking down, I do apologise. I have my notes here, so I didn't want to forget anything to talk about in this video. Second of all, my second thing I've learned is don't close your credit cards, even if you're not using them. And there's multiple reasons why you shouldn't do this. So if the credit card in question, you've paid off the balance, if that one you've had for, let's say, 5 years, when you close that credit card, that is then a line of credit that the lenders won't be able to check. So I would suggest that if you are not looking to use that credit card, probably keep it. Don't put anything else on it, but just keep it open until you've sort of like maybe got your mortgage, if that is what you're looking to do. The second point in this is the actual credit card limit that adds to your total credit limit. So let's say you've got 2,000 on one credit card, that's your limit, and 4,000 on the other credit card, that's your limit. So in total you can spend £6,000, and your utilisation on credit cards is worked out to be at £6,000. But if you close your credit card that's got the £4,000 limit, you're just left with the £2,000 credit limit. And so whenever you put sort of like items and pay with that credit card, your usage looks a lot more because you've gone from having £6,000 to £2,000 in credit limits. So it's important, I would say, just to keep the credit card open for the moment if you are looking to get a mortgage. It's probably best. I mean, you can do your own research into this, but this is something that I've learned. So this is something that then leads into a number 3, which is there is something called a credit utilization, which is taken into account when working out your credit score. And when you apply for a mortgage, this is also something they'll look at. The optimum credit utilization is 30%. Anything over 30% is a bit, they'll look at it and then have to consider it more. But if it's anything above 80%, that makes you look like a high risk. because when banks do a credit check on you, it looks like you're unable to manage your own finances and you're having to rely on your credit card just to get by. Even if this is not the case, this is why it's best to have high credit limits on your credit cards, because let's say you've got a credit card that's the credit limit on there is only £500. If you are then spending £250 on that £500 credit card with that limit, you've used 50% of your credit utilization. So even though it's a small amount, to the actual banks that will be looking at this, it looks like you're using a high amount of credit, even though you're not. So I would say if you can get a higher limit on your credit, then do try and do that. It's best to have as high credit as possible. Obviously, you have to be sensible. If your limit on your credit card is £5,000, I'm not saying go out and spend £5,000 on that credit card. I'm saying if you spend, let's say, £250 on that credit card, because you've got that £5,000 limit on there, your utilization is a lot less compared to if you just had a credit limit of £500. So that is something that should be taken into consideration if you are looking to apply for a credit card. The next thing I would say is important to take into consideration as well is if you have, so not so much with credit cards because you can't get joint credit cards, but if you have a loan that is joint, bank accounts that are joint, or utility bills that are joint that you guys pay together. It could be with a partner, it could be with your parents, it could be with someone you know, it could be with anyone. But the point is if you're coming to apply for a mortgage or somewhere where they need to check your credit, that other person's credit can be taken into account on your application, because that is a joint product that you are paying on. So let's say you've got a late payment on a joint loan, that will affect both of your credits. And so if you do have joint products like that, please do be careful that the other person's credit isn't bad and then negatively impacting your application or anything such as that. So just be careful going into joint accounts and stuff. So number 5, I think we're on number 5, to take into consideration is to please never withdraw money from your credit card. There's 2 reasons for this. One, because the interest on that cash that you've withdrawn is very high. But second is that it makes it look like to credit agencies, or if you're going for a mortgage, that you're not financially stable and you have poor money management skills because you're having to take money out on a credit card, so on credit, to pay for day-to-day living. So that will affect your credit score and it can bring it down. So please be careful. And I would say if you can avoid that, then please do. Tip number 6, I would say, would be don't apply for too many or don't have, even if you don't apply, don't have too many credit checks before you're going to apply for a mortgage or another credit product. So for example, if I was to go out and take out a car loan and put a mobile phone on contract and then decide to apply for a mortgage, that's 3 credit checks that are being done or just on me, on how I pay. And each credit check will affect or bring down your credit score each time. What I've done by applying for those 3 things at the same time is make it seem desperate, that I'm desperate for credit and someone needs to lend me money. So what will happen is I will look like a higher risk to the bank. And so this then affects whether they're going to give me a mortgage or not, or whether they're going to give me a credit card or not, or even with a bank account. If you've gone to 4 different banks and had a credit check done there, it will be one of them might turn around and say, no, there's like 3 other checks here, you haven't, passed this credit check. So things like that can affect your credit score. So please do also be careful there as well. It's important so that you are on the electoral roll. So tip number 7 is credit agencies use the electoral roll information to check your identity, to say you are who you are. And so there is some link to you, to the house that you live in if you're on the electoral roll. And it's easier in a way to check you if you are. If you're not, then again, even though you're not doing anything wrong, you might seem like a higher risk to the banks that you're applying for a mortgage for. So ensure you are on the electoral roll. So make sure you're registered to vote basically at your address. And also make sure, so tip number 8 would be, is all your addresses for like your credit cards, loans, etc. are all current, just in case, let's say you had an old credit card, you moved, but you've not updated the address for that. That might cause problems when it comes to applying for sort of like mortgages, because that open credit will be on your credit score, your credit file even, and it won't match the address that you're currently at. It will be different to your other credit. So that can cause a lot of hassle. So please do make sure that your addresses are up to date and correct. And tip number 9 would be to make sure that you pay your credit cards on time or your bills on time. This makes a good credit rating for you, and that is what is taken into account when you're applying for mortgages or a loan or anything such as that. So it's important to have good credit. A lot of people think that if they don't have credit or a credit rating, it's still going to be easy to get a mortgage. I'm not saying it's impossible, because it's certainly not, but it makes it a lot harder, and this can have a negative impact on your mortgage application. And the reason is credit scores or credit ratings, they're used to predict your future behavior using your past behavior. So if the banks can't see what your past sort of like financial behavior is, they've got nothing to base what your future financial behavior is going to be on. So that makes you a higher risk in their eyes. It's nothing to do with you as a person. It's unfortunately all numbers. So it's just something that is needed if you are going to go for a mortgage. If you can get one without a credit rating, brilliant. Honestly, hats off to you. It's absolutely brilliant. I'm so happy for you. But it is best, if you are looking to get a mortgage, to probably have some form of credit, or like a credit rating at least. Another thing to keep in mind, I think this is tip number 10, is if you do have credit cards with balances on and you are applying for a mortgage, they may ask you to pay that credit card off, or that amount will be taken into account into what the banks will lend you. So if you have £5,000 on your credit card, the bank is going to look at that, know you're making minimum payments, or they might even look at the entire amount and say that they're going to take £5,000 off what they are willing to lend you, because you have to pay that credit or that loan that's been given to you on that credit card back, because it's money that is borrowed. And it's the same with car loans. A lot of people don't realise, if you have a car loan, that again will be taken into account when you go for a mortgage. They will, depending on what banks it is, they'll either take your monthly payments out, or they will take out how much in total you've got left on the loan off what they will lend you. So things like that can decrease the amount of money that you are going to get on a mortgage. So be really careful and think really hard about what it is that you want, and if you can sort of like afford the things that you're looking to do. Like, can you continue to keep the car and get a mortgage as well. Like, do you have enough money to make both payments? Because that is what the bank is looking for. They are going to look at your affordability of what you can pay per month based on your salary, and then say a final figure of this is what they can lend you. So I'm a single person, which is why getting a mortgage for myself is actually really hard at the moment, because I need a higher deposit, because the only salary that's going to be considered in this case is my own. So what the bank will lend to a single person on their salary is a lot less than what the bank will lend to two people on individual salaries, because those two will be combined. So that's just sort of like my situation. I really hope this video was helpful and you may have learned new things that you didn't know about. Again, like I said at the start of the video, I'm not a financial advisor. These are just things that I've learned over time and things that I've come across. Please do your own research as well. But I hope this video has been helpful. If it has, please don't forget to like this video. Please do subscribe to my channel. And if there's anything you'd like to say, please do leave me a comment. Thank you so much. Have a lovely day. Bye.